Good evening and welcome to our webinar on NAPIT Wealth. My name is Steve Walton and I'm the Scheme Manager here at NAPIT. With me tonight are David Cook and David Gosby, Independent Financial Advisors at NAPIT Wealth. They'll take you through the presentation. There will be time for questions at the end of the presentation, so please feel free to use the Ask a Question function, which is in your control panel, and for most of you that will be to the right of your screen. We'll do our best to get through as many of these as we can at the end. You'll also find a copy of the presentation and certificate of attendance in the handout section in the control panel, which you can download for your records, and we'll leave a couple of minutes at the end of the session allowing you to open and save this if you wish. There'll be a short survey at the end of the webinar, and we really appreciate your feedback to make these webinars more useful going forward. So with that in mind, I'll pass you through to David to get things started.
Okay, welcome again to our auto-enrolment presentation. My name is David Gosby, and again I'm here again with my colleague David Cook, and our aim is to provide some insight into the onerous legislation of auto-enrolment. We'll start with a slide presentation, which will be followed then by the question and answer session. So, auto-enrolment. Why do we have auto-enrolment? Well, if we go back to when this all started, in May 2006 the government published their white paper called Security and Retirement, with plans for reform and a new pension system. Auto-enrolment started. This resulted in the legislation of auto-enrolment in the Pension Act of 2008 major reforms. On the 1st of October 2012, auto-enrolment commenced. To date, there are approximately around about 7 million people not contributing to pensions, so we can understand the problems which lie ahead. What is auto-enrolment? As we said, it's a new legislation which employers must, and I have to emphasize the word must. They have to enroll eligible employees into a pension scheme without the need for application. Employer and employee must contribute unless employee opts out of their own accord from the pension. Why has auto-enrolment been introduced? Well, if you look around at what's happening, people are living longer. On average, men will live to 83 and women will live to around 86. We've also seen the ratio of workers to retirees falling over the years, and this is putting additional pressure on the state benefits. Again, people are not saving enough for retirement, so this has further impact.
On the point of people not saving enough for retirement, the facts are that the average pension pot for a person aged 65 in the UK is currently around £30,000. And that gives you an indication of the scale of the problem. Now, Australia have been ahead of the game in this compared with the UK. They've had auto-enrolment in place for 25 years. So it's a case of the UK trying to catch that up.
Okay, thank you, David. When we look at auto-enrolment, the three choices. There's the do nothing, there's the do it yourself, and there's speak to a NAPIT auto-enrolment specialist. If we cover these three sections, if you do nothing, you have to understand that failure to comply is a £400 immediate fine. Daily fines can then apply on top of that from £10,000 a day to £50 a day, so depending on the number of employees. Also, willful non-compliance can lead to criminal prosecution, so doing nothing can be a very costly route. Do it yourself. There is a detailed auto-enrolment guidance for employers, which consists of approximately 561 pages. This excludes any updates and policy and strategy papers and the multitude of documents and templates. It can be difficult to interpret in parts without assistance. There are 33 new mandatory pension responsibilities which one must address. And I'll give you a quick list of the 33 at a glance. I'm not going to read them through. As this webinar is available to download, you can look at that in your own leisure if you wish to.
And obviously we can see from the 33 number of responsibilities that it's not an undertaking that an employer can take lightly, unfortunately, and this just goes to illustrate that auto-enrolment is a serious business.
And finally, the last option, speak to a NAPIT Wealth auto-enrolment specialist and relieve the huge burden placed on your business. Auto-enrolment, staging date. This is the date when the employer's duty first applies. The employer's duty started being introduced in stages from October 2012. The start date is based on the number of people you employ. So the largest pay-as-you-earn employers started from the 1st of April 2012, right at the beginning. This is then followed by medium-sized companies and then smaller companies, and finally new companies coming onto the scene. Any changes to the size of workforce after the 1st of April 2012 won't affect the staging dates. The pension regulator, or often known as the TPR, will tell you 12 months in advance of your staging date. You can choose to bring your staging date forward to coincide with other key or company dates, such as end of year accounting. There's a list of available dates provided by the TPR. If you opt out to do auto-enrolment yourself, you will need to ensure that you carry out the following 5 phases. Okay, we have assess workforce, we have communicate with employees, data management, which is paying of contributions and answering employee questions, choosing the pension scheme and a default fund, and then finally record keeping and ongoing compliance. If we look at assessing your workforce, this assessment must be done on the staging date and then every payroll run. Age and wage-based peoples will regularly jump between different eligibilities. So if we look at the first one, we have eligible job holders. The second one then is non-eligible job holders, and the third one is called entitled workers. If we go back to the top one, eligible job holders, these are people who are aged 22 to state pension age, earnings above £10,000. They must be auto-enrolled with employers' contributions. Non-eligible job holders, these are for people who are between 16 and 21 or state pension age to 74 and earning above £10,000, or age 16 to 74, earning above £5,876, but below 10,000. They have a right in opting in with employers' contributions. Entitled worker is age 16 to 74, earning below 5,876. They have a right to join the employers. They're not required to make contributions, but they can choose to do so. Phase 2 is communication. So once you've assessed your workforce, you must write to every employee, even if they are already in an existing scheme. You must produce and send the appropriate communication, and it must be direct, so i.e. a letter, an email, a payslip, a web portal. Deadline for communication is 2 months after staging. For existing scheme members, or 6 weeks after an auto-enrolment for workers who are not already in a qualifying pension scheme. Ongoing when workers join or change categories. Employers must inform staff of rights to opt out and how to opt out. Employers must not send opt-out notices. You have to watch out for the coercion rules. Re-enroll every 3 years so employee can opt out again. Non-eligible job holders can opt in at any time, and entitled workers can request to join a scheme. Phase 3 is data management. You'll need to take required data from payroll. You can use middleware IT to run your pension auto-enrollment duties, or otherwise it is sort of manually and it is quite hard at times. Handle opt-outs and opt-out requests, deduct pension contributions, and payroll integration with pension provider. It is critical that everything is set up correctly at outset. Answering employee questions. Employees will have queries. You must decide a process for response. Guidance only care required. You must formulate your audit trail of discussion. And remember, companies cannot get involved in any opt-out discussion. Again, can't afford to get this wrong, as correcting mistakes is an administration nightmare. Phase 4 is choosing a scheme. You have to sort of choose, first of all, the contribution basis, and there are 4 options, which I'll cover off in a moment. Review existing arrangements. A new qualifying scheme may be required. Review provider options, whether it's insurers or using the government-backed nest or others. It could be a combination of schemes may be needed. You need to select default investment. And are you comfortable taking these decisions on behalf of your employees? We said earlier on about there are 4 choices regarding contributions. The default choice is qualifying earnings, which is banded generally. These are earnings before income tax and national insurance are deducted, and they fall between £5,876 and the upper limit of £45,000, which is set by the government. So in a nutshell, if someone was earning £20,000, okay, only the earnings between 5,876 and 20,000 would be used for pension contributions. Further on in the slide, we talk about the other options. There's one there, set 1, set 2, set 3. For most people, these are not going to be relevant. They're going to be generally relevant when there are existing schemes. And when there are sort of thing, we would need to sort of have a little bit more one-to-one advice on that matter. So coming back to the qualifying earnings, and we've got here some banded earnings. So we've got earnings between the lower and upper threshold, as we said earlier, 5,876 to 45,000. And that's for 2017 to 18. These are the new figures. Contributions were based on all earnings within those limits. So the contribution levels required to meet the contribution and quality requirements as a percentage of the qualifying earnings. So if we look at the first date, anything before the 5th of April 2018, the employer must pay 1%. The employee will pay 0.8%, and the tax rebate on that is 0.2%. So we have a grand total of 2%. The next band then starts from the 6th of April to 2018 and goes on to the 5th of April 2019, and that is employer paying 2, employee paying 2.4, tax rebate of 0.6 with a total of 5. And finally, anything after the 6th of April 2009 and onwards, we have employer contribution of 3, employee 4, tax 1, total contributions 8. Agreement must be in place for job holders to make up at least any difference between total and employer's amount.
The point I would say here is that if you look at those contribution levels, obviously the government is starting this with the auto-enrolment. The reality is that 8% contribution levels for someone between starting and to age retirement, it's a start, but it's not going to make a huge pension pot. If you look at the public sector, you can see that their scheme contributions are generally about 16%, so that's double what auto-enrolment is trying to achieve. So that gives you again the scale of the problem that the government's trying to address.
Okay, and finally the last phase, which is record keeping. You can use electronic or paper filing systems to keep or store any records. Most records must be kept for 6 years, so it's important that you understand the importance for these records. Employer must keep the records, and paper records, not really practical, need to try and keep electronically if possible. The record must be provided to the pension regulator if requested, and they do. The pension regulator can conduct an audit, and if they have reasonable grounds to do so, i.e. there is a whistleblower, then obviously they will ask further information. And finally, the declaration of compliance. Once you've enrolled your staff, you must complete your declaration of compliance that confirms to the pension regulator that you have complied with your duties. This must be done within 5 months from your staging date. This is a legal duty, and if you fail to complete it within 5 months, you could be fined. Now, again, we have to highlight the point that once you've signed the declaration of compliance, from 3 years from your staging date, you will have to do another declaration of compliance again, and everybody would have to be re-enrolled into the scheme. NAPIT Wealth, well, we can guide you through all the aspects of auto-enrolment journey that every employer now has to take. We can create an action plan to address the 5 main phases. Our dedicated team will make sure everything will run as smoothly as possible. We offer annual reviews and are able to give independent financial advice from across the whole marketplace. This is the end of the slide presentation. So there are a lot of statistics out there of people not going into auto-enrolment, and a lot of information about the large fines. So what I would say is don't become a headline, get auto-enrolled. Now we're going to hand over now to a question and answer period. So if anyone's got any questions sort of thing, we're more than happy to answer them to the best of our knowledge.
Okay, so we have a couple of questions this evening. The first one is, what happens to my pension benefit if I pass away?
Right, okay. What happens to your pension benefit if you pass away? Well, this day and age sort of thing, pension freedoms created a lot more flexibility in the marketplace. And if someone is actually married, then generally they would probably assign that the policy goes to their partner in the event of their death. If they're not married, they can actually have it assigned to go to anybody else that they wish. So the pension pot wouldn't disappear, it would be there, and it would be there until someone spends it. So I hope that answers that particular question.
Excellent. Okay, and the second question, are there any plans for the government to increase the percentage of contribution in the future?
Well, I think, as my colleague David said earlier on that, if we look at the final salaries out there in the public sector where they're paying 16%, if total contribution is 8%. Now, what we have to understand is that what they're saying is that if the employer wants to pay more, they can. If the employee wants to pay more into it, they can. But whether the government will increase these, we don't really know the answer. I feel there is a possibility that they will, because we're seeing all sorts of increases, i.e. retirement age is being put back further and further because there's such a massive deficit with funding people in retirement. So there's nothing written down to say that they will, but there's nothing to say that they won't. So again, I hope that answers that question.
Fantastic, thank you. And another question just come in. Are you able to give advice on private pensions?
Yes. Again, because we're independent financial advisors, we can look at any pension that anyone has, whether it be a personal pension, whether it be a company pension, and we can provide advice, okay, on that. When you do set up an auto-enrolment pension scheme, you can transfer pensions in, but again, we're always going to say take independent advice, because it may be in your best interest not to transfer it in for many reasons. And at the end of the day, you can have as many pensions as you like. What you don't want to do is have some of the old pensions, which are very costly. Okay, so again, anyone with pensions, I would certainly say give us a ring and we'd go through it with you to see what the best options are for you. Again, I hope that answers that question.
Excellent, that's fantastic. Okay, well that's all the questions that we've had this evening.
Okay.
So with that in mind, obviously I'll kind of tie things up now, if that's okay. If you David, if you've got nothing additional to add.
No, we're all okay here, I think, David.
Yes. I think it's a lot to take on board from that slide presentation, and again, obviously, if everyone's got access to it, they can sort of mull over it at their own leisure, can't they?
Excellent. Okay. Well, thank you everybody for joining us this evening. And if you have any more questions, don't forget you can contact NAPIT Wealth on 0345 241 6600, or you can drop them an email at info@napitwealth.co.uk. We'll be making a recording of tonight's webinar available tomorrow morning on our YouTube channel, and we'll leave the webinar running for a few minutes now to allow you to download the certificate from the handout section. If you can fill out the survey once your webinar closes, we'd really appreciate your feedback. And future webinars will be announced on our online forum, social media, and over email also, so keep an eye out for those. Once again, thank you very much for your time and enjoy the rest of your evening. Good night.
Good night.
The questions weren't too difficult, were they? No, the questions that no one asked about whether it's all correct. the thing is, though, if it's a real-world webinar, you know, and people can do it,
Yeah.
you can't put a, you know.
Yeah.
You can't put a figure on that, really.